Hi there, I'm James Smith and I'm an economist at ING covering developed markets. And I'm here to talk macro, where there's a sense that we're coming out of the COVID-19 crisis. The worst is behind us. But the global economy is not totally out of the woods just yet. And in particular, there's three big questions that I'd like to take a look at with you today. First, naturally, is how quickly the recovery process from COVID-19 is likely to be. And the key word here is divergence. It's divergent because of the vaccine rollout, but government spending is also playing a pretty big role as well. And actually, for the big economies like the US, the UK, Europe, this may well prove to be a bigger driver or as big a driver of growth this winter as the vaccine rollout. The second question is inflation, big topic in financial markets right now. How long will inflation rates stay where they are, well above target already? We'll look at that. And that hinges on energy prices, but also supply chain disruption as well, both of which actually are only getting worse as we head into the autumn and the winter. And it depends too on the jobs market as well, of course, which is in the midst of a real mismatch in many places. And finally, if we are indeed looking at higher inflation rates, what does that mean for the central bank? Should we be expecting some imminent action? Certainly, central banks are divided on how worrisome inflation is likely to be. So let's look at those three things in turn. Now, firstly, on the recovery, if I go to our first slide. This chart really shows that it's a different story on either side of the Atlantic. It shows the level of GDP since the crisis began. And if you look at the UK or indeed most of Europe, what you see is the economy is still yet to reach pre-virus levels. In the US, it's a very different story. GDP is already back to where it was before the pandemic hit. And in fact, by early next year, the size of the economy will probably be even bigger than it would have been had the pandemic not happened at all. That's to say, if GDP had continued growing in its pre-virus trend. So it's a diverging story, and a big source of that is government spending, as I mentioned earlier. Specifically, how the US and Europe differed in their immediate response to the crisis. So what we saw over in the US was, you might remember, we saw a huge spike in the unemployment rate early on, but the government compensated for this by ramping up benefit payments considerably. And that's only ended fairly recently. Up until the start of September, the federal government was topping up state-level benefits by $300 a week. And the result was, certainly if we look towards the beginning of the pandemic when benefit levels were even higher, the result was that over half of workers receiving unemployment payments were earning more than they were before the pandemic began. So that was a huge government stimulus. Now, this next chart shows how personal incomes in the US have changed, and in particular how different things have contributed to that since the pandemic began. Now, the grey bit you can see, that's the boost from these federal unemployment assistance payments. And at the peak, right at the beginning, it was boosting incomes by almost 1%. Add in the huge stimulus checks we saw as well at various points in the pandemic. And what we saw was incomes were up considerably, even though at the time private sector wages were contributing far less. Now, where we are now heading into winter, the effect is kind of switching around. The government support is fading. Those support payments have been reduced. But the blue bit that we're looking at here, private sector wages, they're really offsetting it. And really the story is that the jobs market in the US is really heating up, and I think that bodes well for consumer spending in the US over the next few months. Now in Europe it was different. Furlough protected jobs. It was great for both consumer and business confidence, but it also meant a fair chunk of workers, predominantly low income workers, were being paid less than they usually were. So what we saw was Yeah, savings levels rose considerably on average in many countries, but it didn't benefit those lower earners. And don't forget, it's these workers that really drive the macro level changes in consumer spending. So it's not that surprising then, back on my previous chart, that we're seeing these big divergences open up on both sides of the Atlantic. You can see it in retail sales as well. In the US, they're still up almost 20% on pre-pandemic levels. In Europe, it's more like 5 or 6%, so huge differences. Now, of course, some of this divergence is also down to coronavirus. I'm not going to, of course, go into the various pandemic trends that we're seeing, but only to highlight that we're still seeing a big difference in vaccination rates at a global level. Now, this chart, complicated looking chart, but all it's really showing on the x-axis is vaccination rates plotted against the current growth in weekly cases. Now, the good news is there's a lot more countries towards the right-hand side of this chart than there were a few weeks ago. But even with that, there are still big differences. So if you look at the US, has a big headline rate of vaccinations, but we've seen a big rise in hospitalizations over the past few weeks. Earlier on in the summer. And that was partly because only around 80% of vulnerable age groups in the US have been double jabbed. And the result has been a bit of a knock to confidence, perhaps. We've seen it in lower numbers of people traveling around the US, dining numbers as well. The UK, by contrast, has well over 90% of the vulnerable age groups protected. And correspondingly, it seems like the UK's fared a bit better economically this summer from the Delta wave. Now, it's also easy to forget as well, and this is important as we go into winter, it's not just lockdowns that have hit growth so far. And in actual fact, analysis has shown that it's consumers' own, voluntary actions that makes the real difference. If people socialise less, stay at home more, and that's the risk in winter. Even if we aren't getting lockdowns or even fairly mild restrictions because the bar has been lifted so much, potentially you could still see some consumer caution creeping in if we were to see cases really rising. But if we look beyond the developed markets for a moment, it's pretty clear that vaccine rates are and probably will remain for some time too low to provide enough of a barrier against the Delta variant. And now the concept of zero COVID is therefore still pretty prevalent. It's likely to be that way for a little while longer, so lockdowns and disruption remains likely. And I mention this because this matters not just for the pace of the recovery, but actually more immediately it has implications for inflation. Big topic, as I mentioned, in financial markets. And what we're seeing is these local lockdowns, particularly in Asia, are really affecting global supply hubs, freight capacity as well. We've seen it in Vietnam, factory closures affecting clothing, electronic brands. Similar story with Japanese car makers over the summer as well when COVID cases rose. And of course, the closure recently of a major port in China has meant that the port was operating below its capacity for several weeks, and that caused backlogs as well. And the problem is each of these setbacks really causes a fresh set of problems for supply chains, most obviously through delays, but also containers are in the wrong places as well, which in turn makes it even harder to catch up. To give you a perspective of how bad it is, less than half of ships globally have been arriving on time at their scheduled arrival points in 2021 so far. And all of this, costs time, but also money. And the benchmark cost of shipping a 40-foot container from Shanghai to Los Angeles has gone from around $1,500 pre-virus to $4,000 by April. And now after the most recent disruption, the cost is now more than $12,000, and it's rising virtually every week. Of course, shipping is only part of the cost inputs, of course, but the reality is that supply chain disruption is only getting worse. So that means these high rates of inflation we're seeing at the moment in the US, inflation is already above 5%. It's likely to stay high for a while, and probably in the case of the US will stay pretty close to 3% by the end of 2022. So it's a big story. The energy story in Europe's really not helping either. Gas-exposed countries like the UK, like Italy, are seeing really sharp rises in power prices. Italian household electricity prices rose by 30% at the start of October, so that's a big hit to consumers. So on that basis, what should we be expecting from the major central banks? Well, it's easy to assume that inflation implies higher interest rates, but as ever, it's not that simple. Central banks don't actually have that much control over late-running ships or local lockdowns. And like the spike in energy prices, if anything, higher goods prices really will just act as a drag on consumer spending as we head into the winter. And that doesn't really seem like a big reason to be hiking interest rates aggressively. Now, I will really come back to wage growth. Just move on to the next slide, which shows our central bank expectations. It comes back to wage growth for central banks, as it often does. Are wages rising fast enough to compensate for these higher costs? And again, not a straightforward question to answer. As I mentioned earlier, in the US, really hot economy right now. There probably are broad-based wage growth, signs of wage growth right now. But in Europe, there's really a two-speed jobs market. Take the UK, we're seeing headlines day after day about shortages of lorry drivers, food workers, and there's no doubt that wages are rising considerably to address the issue. But at the same time, the furlough scheme has recently ended. About 2% of workers were still furloughed for all of their usual hours when the scheme ended. Both can be true at the same time, but what we're seeing is a mismatch in skills and locations. So some areas of the economy are running hot, others aren't. And the dispersion in growth rates between different sectors is much wider than it's arguably ever been, certainly in recent history. So we hear a lot about whether inflation is going to be temporary or not. But actually, for me, the question is, the question is really, which part of this twin economic story is more dominant? If those staff shortages we're seeing in lorry drivers and so on don't broaden out to a wider range of sectors, then potentially what you get is, you don't see broad-based wage growth, particularly at a time where slack in the jobs market is increasing with the ending of furlough schemes across Europe. And again, that reduces the need for central banks to act. Having said that, I think it's pretty clear that the time for quantitative easing is probably over in quite a few places. They're very useful asset purchases at times of market stress. They're not particularly useful when things are really relatively normal as they are now. So that's why we're hearing more about tapering in the US. We can expect the Fed to be cutting asset purchases by the end of this year, and they'll probably stop them all together by around late spring, early summer next year. Now, the bar for rate hikes is clearly a little bit higher, but even in the US, we think probably we may well see more than one rate rise in 2022, potentially starting from September. In the UK, where I am, markets now aggressively pricing rate hikes, the first potentially in February. That's maybe a little bit too early in my mind, but nevertheless, we are going to see some interest rate rises here during 2022, I think, at some point. And the Bank of England is further ahead than most in talking about reducing the size of their balance sheet. They said when rates hit 0.5%, they're going to start shrinking the balance sheet. And in fact, that begins the job of reducing the huge amounts of QE that the Bank of England's done over the past couple of years, and expect other central banks to talk about this as well. In Europe, finally, as ever, it's a slower story, likely to be a lot less dramatic. The European Central Bank might inch towards tapering sort of around the turn of the year, but it's going to be a very slow and steady affair. So to sum all of that up, let me return to those three initial questions that I framed at the beginning. How strong will the recovery be? Well, it's pretty clear that it depends where you look. The US is running very strongly, even if it is a little bit more exposed perhaps to further waves in COVID than parts of Europe, although this is at the margin, I guess. The latter, Europe, by contrast, it's closing on pre-virus levels, but I think the recovery is likely to be a little bit less exciting. On inflation, well, we're likely to see these high rates of inflation persist through 2022. Could take some time to get back to target, assuming these supply chain disruptions take quite a long time to heal. And as I say, that leads to some differences in central banks. Persistent inflation in the US may well lead to tightening from the Fed quicker than some expect. But in Europe, as I said, it's going to be a steadier story. So as I said at the start, The prospects for the global economy, I think, are improving, but we're far from out of the woods just yet. I'll stop there. Thank you very much.